guys, and glad to have you on board again today. We are going to update the weekly scenarios, so I assume that you have looked at the weekly update first. These updates are not visible into the YouTube channel. They are released each and every weekend into TradingView. You should see and find your way out there really easily. Anyway, so I assume that what's been said out there throughout the weekend is well known by everyone at that point. We're just going to develop on those previously said things as we reach out to technical clusters highlighted back then. So, of course, this week's cluster was the 31st because that's basically closing the month, closing the quarterly candle, and all of those things. Things can turn out to be stupid. That's what we've said out there to give you a global context to follow in terms of portfolio management. So this is definitely not the type of areas in which you want to go with the maximum risk taking over the context you will be trading. So more like dividing the appropriate leverage by 2 would seem totally legitimate. So that mostly now depends on what types of context you will be able to find. And today I'm going to try showing you multiple opportunities depending on your level of maturity with the strategy. Of course, the higher risk taking means the higher returns and the higher and the better risk reward ratios. So today I'm going to show you an opportunity for those who are experienced enough to reverse trade and an opportunity for those who are far less experienced at that point and who will just have to deal with third range boundary, okay? So there's always multiple options, and if I had enough time I would be able to share them all, but most importantly, at first I don't want to. You have to be able to fish your own food rather than being fed up, okay? So this is really not about that. This is not my style. So I'm teaching you how to do these things. You figure out the way to do it on your own independently all on the other days. Today is just like an example of the way you should do things independently. So if you want to go for a more attractive risk reward ratio, you generally will look for reverse trading opportunity. Though, of course, the S&P 500 is just not showing anything interesting. It's just totally boring, flat. So this looks like a trend, but a range, but a trend, but a range. So fuck it. Just go elsewhere. When you don't know what to do, you just don't do anything. There's another index that I like a lot, which is the German DAX. This one, oh man, that's definitely a bullish market. So I can do my personal analysis out there, see if I'm going to be able to figure out a reverse trade, yes or no. In here, there will definitely be one. Let me just tell it. Let me just show it to you, okay? So if we have a look at the German DAX, if we have a look at relative strength, let me just, okay. In terms of relative strength, if I take this, you can see that over the bull run, the global bull run, okay, German DAX has been an average candidate, overperforming the S&P 500 still. And most importantly, if we put it into the recent market top reference point, okay, we can see that out there, German DAX is the best performer. So this is definitely one of these kind in which we get through the correlation pattern state. Okay, we've got markets going down, markets going up. This simply makes no sense. Okay, this decorrelation structure has an imbalanced state in which in the end, either we're going to do this, okay, and go for a negative decorrelation, overall prices will drop, which seems to be the most probable outcome in my personal opinion, which means the heavy performers are probably the one that's going to be hit the most, okay? Of course, there's an alternate possibility in which the decorrelation go for a positive phase, which means in that perspective, these will be the guys to catch up on, and there will be just a slight retracement of the leaders to go for a positive general outcome. I don't think that's the motive because you know I am still going for consolidative trades into the S&P 500, leading me to believe that the entire market decorrelation will pretty much lead to some deterioration. Just the laggers might now be able to catch up on these prices. The Nasdaq, for example, the Hang Seng Index could be showing some improvements or stabilizations where the overperforming guys might be taking a hard hit. Okay, so that's the reason why I'm going for the German DAX, but I also assess that this is where I'm going to get the best risk-reward ratios, this is where I could make the best gains, but this also comes with a higher risk-taking. In here, we're going to compensate that by lower position sizings, okay? So This is expert trade. So in our expert trading context, we're going to look for potential reversal signals, figure out if there is a context we can exploit. We're still going to try validating the natural risk taking in there. But we also know that if we ever trade, we're going to divide the position sizing by 2. So we're certainly not going to take 2 to 3% risk, but a maximum 1 to 1.5. We're dividing the risk taking by 2 because, of course, this is where we're going to get the best risk reward ratios. This is where we're supposed to be, having the best risk reward ratios, though it's also increasing risk. So we're taking best risk reward ratios and we decrease risk taking by reducing the position sizing. Okay? Still, for reverse trading, we need a reverse context, which means we need to figure out what this thing is. In here, looks like a range, the moving average is in between, so this is not a time frame in which we're going to go reverse trading, but this is where we're going to see the underlying price structure. Looking at the trend channel, we can see that this was a trend. This looks like pretty much being another one. So what is this structure? Okay, we're gonna go easy. Normally you are experienced traders, so for those of you who are beginners, if you don't understand it all, don't mind it. Okay, I'm going fast for the experienced traders. This is wave 1 extended structure, so our maximum potential is retracing to the previous resistance, in which we should find some buying opportunities as an overlapping area. We generally tend to create wedge concentrating structure, so trend lines have to be not parallel. Okay, we're supposed to have converging trend lines, so this is our first trend line, so the other one has to be steeper than that. This is our expectable supportive area, so everything leads us to believe that this is where buyers will step in. So this is our maximum target price. All right. Now, are we in a reverse context? Yes, we are, because those wave 1 extended structure offer us an alternate structure in which the trend has been settled with the first wave. So we need to understand that we're only going to catch the crumbles of these waves. Then the second wave looks like a pullback. The third wave looks like a final excess that follows with another set of pullbacks, so 2 pullbacks into these structures, and then there is another second final excess. Okay, so this is a structure that has trend in the beginning, generally V-shaped volume, lack of supply, then comes a first final excess. Everyone is extremely bearish out there for stupid reasons, because the real reverse trade is going to be there. The one we're going to get is simply going to be the equivalent of a divergence, which means an area in which we risk manage, but certainly don't go reverse trading. Okay, it's traded like a final excess, but it doesn't provide the sustainable gains for a reverse trade. So we're going to have to be cautious. That's the reason why we divide leverage by 2. We trade it just like a final excess, but we know that the expectable targets are lower than a normal reverse. All right, so we also know that this altered structure generally tend to reverse inside the context because of the converging trend lines rather than trading above. So are we inside the resistant context? Yes, we are. We're perfectly aligned into the area of interest. We generally also trade closer to Fibonacci extensions of the previous wave, and we're trading at 61% Fibonacci extension. Let me just highlight it to you guys. Okay, this is real quick assessment. All right, here we are trading at 61. I'm sorry, I should have done better in here. Okay, real quick post. No, it's all right. So this is all about it. We're trading at the expectable target. We're inside the context. We're trading with the trend channel. Everything we need. Still, the reference time frame for us to trigger the signal entry is going to be the 4-hour chart. We need to trade at least in here above, or really at least inside the resistant context, possibly and better a trade above. So we're definitely into the area of interest. We're having breakouts that have been highlighted to be range boundary breakouts. So god damn it, that's everything we need. We know a range is very likely to build nearby, so that's what we want. Okay, we're definitely into an area of interest, trading above the context and so on. Still no technical signals, but we've got this as a risk limitation, which is more than enough. I'll personally trigger my entry on any 4-hour reverse candle. Then of course there's a limited time offer, which means if by the 8th or 9th of April we're still trading this nearby area, we'll consider it voided. Okay, so limited time offer, we can limit the risk with this signal. Would be better to get a momentum signaling pretty much sooner rather than later. We're not going to get aggressive. We're going to wait for a candlestick reversal structure, but we're definitely trading into the expected area for a reverse trade. That's all about it. For speculators and experienced traders, we got everything we need. We just need a price signal. Then, of course, it's a reverse trade, though it's going to keep complicated. It requires tough risk management and stuff like that. So for other people, like less experienced traders, you have plenty of other options. You know that the favorable direction is to consolidate stocks. But you also know that consolidation might not necessarily come out of reversal. Some other things, like for example, diving into sectors, might give you opportunities to figure out something you know, like third range boundaries, okay? If the global stock market is on the verge to consolidate, that means some sectors probably anticipated it. Oh, well, look at XLE and XLF. These are energy stock sectors and financial stock sectors. And well, just look at that. Don't you have a very nice third range boundary opportunity into the financials? Yes, you do. So this is where you want to go. Rather than going reverse trading the German DAX if you don't know how to do, sure thing, this is where we'll get the best risk-reward ratios. But also, why would you heavily risk take if you don't know how to do this? Just pure and simply look for third range boundary opportunities into subsectors or eventually into the German DAX itself. Look at the 30 values and try to find one that is a bearish third range boundary opportunity right now. And you would find yourself into a situation that you can handle rather than going into a situation that is overly risk-taking over your level of experience. Okay, so in here we can definitely see that there's a third range boundary opportunity into XLF. Go out there, find a suitable time frame to do this. Let's just try doing it real quick. Okay, taking the XLF, just try figuring out which context is giving you the third range boundary. Well, sounds pretty simple to figure out. Here we've reversed the trend channel, so this is an H1 time frame context. Okay, H1 time frame has a trend, has reversed the context, and is pulling back out there. You're definitely able to trade a bearish third range boundary, and oh gosh, the algorithms detected the context for you. So it's really, really nice to trade. Have a look at this. This is your risk limitation. Cycles are totally okay, but the thing is that this means volatility could emerge. So be cautious, reduce position sizing, but you're definitely good to go to short sell XLF. That's pure and simple. That's how you do things, okay? You don't handle over risk taking, because if you try to do something you're not fully aware of, you're just going to do dumb trades. And most importantly, you're going to make mistakes. And that's not what you want. You want to be handling and trading stuff you master. You don't understand the market, but you understand the structures underlying prices. You understand how value, which is the context stuff and so on, behaves along with prices. Price is what defines either you're going to make a gain or a loss, but no one can predict price. Price is just randomly chaotic, but value isn't. Value is following a set of rules, though we're predicting prices using value, okay? So there are some value shifting that you simply can't figure out, just like reversals. It takes a freaking long time to teach you how reverse trading actually underlines itself. To go for third range boundary is much easier, so go for third range boundaries unless you have enough experience to try looking for reverse trading, which is definitely not going to be an easy task today. Alright, both case scenarios requires lower risk taking because of the global context that we've talked about into the weekly updates. We're closing the month and the quarter, so it's not an appropriate time to risk your capital. Really go divide the leverage by 2. Still should provide some nice trade. And if you want a quick update on cryptocurrencies, because we're also trading the weekly update areas, well, I see absolutely no reason to be bearish now. Actually, I just recorded it for the French guys, and this wasn't yet there. So we're still going higher. Okay, so this is the third range boundary, previous third range boundary area. Remember 1, 2, 3. That is a delayed third pattern highlighted back then. Okay, so oh fuck me. Okay, that's 1, 2, 3, 4. Though this is a fifth wave, okay? We don't sell out there. The question is, are we going to succeed breaking the third range boundary? And we are trading at this level now, questioning whether we will just break out like it was nothing and we're going to go straight line for a 1-to-1 ratio between 64 to 66. This would be the breakout area, so expected targets will be this. Remember that same thing goes in here. We're into a wedge creation structure, so we reverse trade inside the context. So I doubt we can go higher than 65. So considering it like 63 to 65K area of interest for me, that's the area in which I look for reverse trading in the Bitcoin. Reverse trading for experienced traders, profit taking for others, okay? You don't short sell unless you're experienced enough to know how to. Okay, it's really simple as that. You define the profit-taking amount depending on the signals you get into this area. If this is just taking profit patterns, 25% would be more than enough. If you're having exit signals and so on, definitely take 33 at best, half of your Bitcoins eventually. Don't go any more than that. Taking more than 50% now, as we would just be divergence trading, would be absolutely staggeringly stupid, okay? That's pretty much all about it. Otherwise, we're going to reject the third range boundary area and very likely going to range into this area before pushing higher later, possibly next week. Okay, so pay attention to this area. This is definitely not an area to get excited with, more like an area to be cautious about, but let it happen because probabilities to go higher are still significant at that point. Bye, guys.